ExxonMobil holds a specific place in the American financial consciousness. As the largest oil company in the country and a perennial dividend king, it projects an image of absolute corporate stability, reliably generating tens of billions of dollars in annual profit. When Wall Street looks at the company, they focus strictly on that traditional balance sheet. But beneath that pristine surface, an entirely separate portfolio of off-the-books liabilities is rapidly accumulating, completely unseen by the public. Today, we are conducting a shadow audit. We are breaking down 20 distinct corporate, legal, and operational risks that are unfolding simultaneously behind closed doors. Ignoring these 20 hidden threats means analyzing the company based on incomplete data and potentially miscalculating its future stability. Let's start with their highest growth asset, the oil fields off the coast of Guyana. In 2016, the company signed a production sharing agreement that established a 50-50 profit split between the extraction consortium and the Guyanese government. This animated chart shows how those profits were actually distributed in 2025. Out of $12.5 billion in total profit, a true 50-50 split would give Guyana $6.25 billion. Instead, the consortium walked away with $10 billion, while Guyana received just $2.5 billion. This flowchart illustrates exactly how that gap opens. Through Article 15 of the agreement, Guyana pays Exxon's taxes on the company's behalf, pulling the money directly from the country's own share of oil revenue. The local tax authority then issues a receipt to Exxon, which the company uses to claim massive foreign tax credits on its global filings. While the company publicly maintains that cost recovery consumes 75% of its revenue, their own internal 2025 accounts show costs amounting to less than 30%. Operational transparency is also under pressure. In 2025, the company submitted 51 discovery notices to the government, yet kept over 20 of those material oil discoveries completely hidden from the public. Simultaneously, a $19.6 billion cost audit was handed to the government and then withheld from citizens for over 200 days. When the math of a 50-50 agreement results in the company taking 5 times more revenue than the host nation, it creates a material risk. These discrepancies increase the likelihood of future sovereign backlash or a forced renegotiation of the entire contract. Move from the accounting department to public relations. Over the past 25 years, the company executed a coordinated advertising strategy across 7 specific categories, ranging from shifting carbon responsibility onto consumers to exaggerating their commitments to renewable energy. Take their algae biofuel campaign. They ran nationwide commercials featuring employees standing in massive algae ponds, explicitly implying they were farming alternative fuels at scale. Internal documents later revealed they knew the technology was decades away, and in 2022, they shut down this small-scale laboratory reality entirely, without ever selling even a single barrel of fuel. Look at this comparison charting their internal science against their public messaging. 83% of the company's peer-reviewed papers and internal documents acknowledged that human-caused climate change is real. Yet, only 12% of their public advertisements shared that fact with the consumer. That specific gap between internal knowledge and public warning is now producing tangible financial damages. In May 2024, a Philadelphia jury ordered the company to pay $816 million to a mechanic who developed cancer from benzene exposure. The court found that leadership knew about the cancer risks as early as 1964 and chose to stay silent. And that verdict is just the first domino. Broad consumer fraud and climate deception lawsuits have survived motions to dismiss and are actively advancing toward trial in Connecticut, Massachusetts, Colorado, and Hawaii. Reputational issues from the 1990s have matured into near-term, billion-dollar courtroom liabilities. Operationally, the physical hazards are piling up alongside the legal ones. In just the first half of 2025, oil and gas operators reported 620 spills. Compound that with this entirely new lawsuit filed by the state of California over alleged deception in corporate plastic recycling, and analysts estimate investors are staring down $20 billion in plastics-related liabilities in America. As these risks mount, the company is changing the rules of how it is governed. In September 2025, they secured permission from the SEC to implement a retail voting program. The program allows retail investors to automatically pledge their votes in line with whatever management recommends on every ballot item. Governance critics call this a loyalty oath. Simultaneously, the company took the extreme step of filing suit against its own climate-conscious shareholders, refusing to drop the case even after the investors withdrew their proposals. Just 4 years ago, activist shareholders successfully elected reform directors who were credited with saving the company from its own lack of capital discipline. By creating a mechanism for pre-committed management votes, the company is making that exact type of outside intervention significantly harder to repeat. This defensive posture extends to the geopolitical stage. CEO Darren Woods is actively lobbying against the European Union's sustainability laws, threatening to seize business in the EU if the rules aren't revised. To underscore the point, the company paused 100 million euros of investments in the region. From litigating against its own investors to threatening to exit major markets, the company's recent strategy has shifted towards insulation from external oversight. This matrix displays the shadow ledger's true scale: $10 billion accounting gaps, 25 years of scientific suppression, advancing fraud lawsuits, and management-aligned voting. These aren't speculative theories. Every item is documented in SEC filings, jury verdicts, and audit reports. The mainstream narrative focuses on dividends and buybacks. But for the investor, the critical question is whether this specific combination of concurrent risks has been accurately factored into the current stock price. Out of all 20 items in the shadow ledger, which risk do you think poses the biggest long-term threat? Let me know in the comments. Thanks for watching. Hit subscribe, and I'll see you in the next one.